Hey everyone, hopefully you're having a good day. My name's Andy. My channel's Finding Value. Today I'll go over what my returns were for 2023 and what my 5-year um, annualized return is. I know some people wanted me to go over this that were potential people who are going to join the website. I will also share um, what this looks like in terms of returns if people have invested money. I know because when you talk about percentages, people don't grasp the percentages very well. So I can go over that as well. And maybe I'll go over 2023, some of the stuff I got right, some of the stuff I didn't get right, and what I think may occur in 2024. Not necessarily predictions, but more of things that I am looking at uh, for potential outperformance. Obviously, people on the website get my picks and the reason why I'm going into things. I'm doing a lot of training sessions coming up for people who want to learn how to invest. And I don't think you can get these types of returns if you don't know how to invest. I mean, what I'm trying to do is I'm trying to continually reduce risk, and I've taken some good risk looking backwards. And some people measure risk in terms of volatility, but if you're not doing things in a leveraged way, and I use no leverage, I don't use options, I use no leverage or anything. I just really buy stocks and hold them. So I'm not taking a very risky approach from that perspective to obtain the returns that I am getting. I do not hedge my portfolio. All I do is I look for value in the market. I buy stuff when it's very cheap based off of the three pillars that I created a while back. The three pillars is ratio investing. So using ratios to identify where the value or where the cheap sector is. Market conditions, that's where you're going to see an inflection for the sector to hopefully turn into favor. You won't nail it perfectly. No one will. We try to, but no one's going to nail this stuff perfectly. But if you use a long enough time frame, the returns will come. And then the third one is I use a lot of technical analysis to determine what stocks to enter. There's fractals that I look at, and we'll dive deeper into that if you're part of the website. We'll do another training session where I really dive into all this stuff. Hopefully, it's not too complicated for people. I think you guys can probably get it. And so I use fractals, technical analysis. I look at the size of the patterns, all that stuff. And then I'm looking for a total alignment for all of that. If you can put fear into the mix, it's going to juice the returns to the upside. So if you can buy during a time frame when there's a lot of fear in the market, that is when you really, really, really can outperform the market. So let's go over my performance. I don't have the performance. I didn't screen capture it for the year to date because it didn't include um, my dividends that I received. So doing the calculations, I was a hair over 40% on a year to date performance. So I was a little bit over 40% with dividends included, and with this last week going up a little bit. So I was up on all the accounts a little over 40% this past year, including dividends. A lot of my previous returns and the way that they're calculated does not include dividends. And I am in very large dividend paying companies. As you're part of the website, you know that I push a lot of dividend stuff. And some companies don't pay dividends. I'm looking for share price appreciation. So I was a little over 40 something percent for this past year. Now, looking at this is a screenshot from one of my accounts. It's my main account, and all of the accounts that I have in this, which is 6 total accounts, I believe, is in this one account. If you look at the 5-year annualized return, I'm returning 37.25 on an annual basis for the past 5 years. um, not including dividends. So my 5-year annualized return is 37.25% using the basically using my approach. Now, I think I can improve that even higher a little bit, given the market conditions that I think are coming, which will be a third leg in the commodity sector. Whenever that does hit, it's going to, I think, do better than what I've even performed. And I think I'm picking very good risk reward companies where I've reduced risk further, and I'm hopefully keeping a lot of the upside potential in those asymmetric bets. So when you add dividends into this, my guess is I'm getting on the portfolio probably another 5% bump, 4 or 5% bump. So I'm probably at 30, no, I'll be higher than that, probably 42% maybe. That's basically what I received this past year. So a little bit over 40% is my 5-year annualized return. What does that mean? I put the 37.25 in there, $100,000 investment at the end of year 5, which is my performance. I would have turned 100,000 into $487,000 on average. That would be my average return here. And if I continue to perform the way I do over a 10-year period, I would have turned every $100,000 of initial investment into $2.37 million. So if I have let's say I started the commodity bull market with $600,000, my portfolio net worth, and that's not including any of the precious metals holdings, is 2.922 million, and I'm on trajectory to hit maybe 14 million plus if I were to maintain that trajectory, which I'm not stating that it's not in the bag. I'm just stating that's where I could potentially be. If that trajectory continues, it could be somewhere in that ballpark, what I'll say. Now, looking back at 2023 and some of the things that I got right and some of the things that I got wrong, and what am I doing to improve investing? I think it's always important to look at what I can improve and what I'm refining and what I'm doing to do it. What I think I was doing some years ago is I think I was taking on too much risk. I was taking on too much risk, and the symmetry in those risk reward bets were not as good as I was hoping. So some of the things and some of the changes that I've adopted over 2022, 2023 especially, is I'm trying to suck out as much risk as possible. And by doing that, I'm choosing companies and I'm really focusing on the companies that provide exceptional symmetry. Exceptional symmetry means that I'm highly focusing on large upside potential with uh, the risk being handled by the companies having infrastructure in place. By trying to identify the best risk reward entry points. Symmetry, you've got companies and companies across the spectrum. The company itself is not necessarily the sole thing that determines your risk. Your entry point does too. You can take very low risk companies, so to speak, like price to earnings, infrastructure, ability to generate cash, and buy them at very risky points in time. So what I'm trying to do is I'm trying to buy riskier companies at very low risk entry points. And the risk and the volatility is going to carry my portfolio upwards. And I'm handling the risk by my entry point. That's how I'm doing it. The way that I'm finding these entry points is the 3 pillars that I try to teach on the website. The 3 pillars is technical analysis, ratios, and market conditions. So I'm buying companies that are in unfavorable market conditions, where the sentiment is bad, and they've got technical chart patterns that look like they're bottoming, and the market conditions, I think, are coming into more favorable conditions. It doesn't mean that you buy something and it will automatically go up immediately. You buy something, and when the conditions come into favor, that's when they get repriced. And that repricing is what's giving me the returns. So the market conditions changing is changing the ratio or the valuation of the companies. And that valuation change is what's giving me the returns. So the market conditions essentially are what are revaluing things. And really, it's just going from negative sentiment to positive sentiment or more positive sentiment. And we're identifying where the sentiment is the worst and buying when the sentiment is the worst. And guys, it's not necessarily easy to do that, but it's 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 something that you have to learn. And I don't know another way to make the amount of money uh, in the markets and be a part of the herd. You just can't do that. So I think you have to separate yourself from the herd. You have to rely on things that price isn't your determining factor of buying something. Um, People like to think linearly. They like to think that a trend that is in motion will stay in motion. And what I'm doing is I'm trying to find inflection points where things are down and they're turning. Sometimes they're in a stage one basing pattern. Sometimes they uh, are in an accumulation cylinder or something like that. And I think you have to know what those patterns look like, and you have to know that you're buying something that's very cheap uh, in order to do it. So, um, looking at 2023, I'm going to continue to refine. Uh, I think we've got good ways of entry points. Yes, I'm going to continue to refine the companies as best as I can to find the best risk reward companies in the market with the highest probability of success. So you can have a company that's risky, it becomes less risky with time as the commodity goes up in price. So the entry point may have the most amount of risk in the beginning. We're reducing our risk by looking at the commodity itself, using technical analysis with commodity, looking at the market conditions, which involves yield curve, inversion or uninversion, and all that stuff, and trying to tie that all together, and then taking a time frame where you can be successful. It doesn't mean that I put all my money in all this stuff in one investment or one sector. I spread it out amongst multiple sectors and I buy them when the entry points are there. And then I hold them as long as I think the risk reward is good and that there's a lot of upside potential. And you have to keep in mind as a company, uh, as the commodity price goes up, a company may have its risk go down because they're paying down debt. They are buying back shares. They are doing things to enhance the value of the shareholder and reducing risk at the same time by paying down debt. So even though some of the reward to the upside might be getting yanked out of the stock, your risk can go down as you hold it because they're paying down debt and reducing the share count. So I am enticed to continue to hold it even though some of the upside potential has gone away. So is a lot of the downside risk. So your risk reward remains very favorable still, even though the upside may not be as favorable as it was when you first purchased it, because your risk is going down as they pay down debt and uh, as they build infrastructure, as they grow the company, et cetera, et cetera. So that's what I'm going to continue to do going forward, and I'm going to try my best for everyone on the website to get similar returns. Now, your returns may not mimic mine completely. My weighting might be different of the companies than your weighting, and each person has different risk profiles. Um, I am continuing to go down the risk curve and try to maximize my performance per unit of risk. That's really what I'm trying to do, and I'm trying to find companies that are just in that sweet spot of small cap, mid cap, large cap, and then finding the large caps that can give me mid cap, small cap type growth if they exist. And I think in certain sectors that is possible. There's also certain sectors where your returns are not based off of the necessary large cap, small cap. Like people think small caps have to outperform, but what if there's large caps and the way that the company is set up where you get all the upside potential and not as much of the downside risk with a small cap? Something where like the day rates of something can go up on all of the things that they own. So a large cap would be more favorable than a small cap because they're not really, no one's really building anything new. But if the day rates go up of whatever it is, you get all the upside potential in a large cap company without the downside risk. Well, I'm buying all the large caps. That's the way that I've been doing it. And that's some ways to reduce risk and keep the upside potential in a lot of these companies. And some of them I'm going to go after some of the risky companies because the upside potential is so large. It is so large. It's like 30, 40, 50 times your money large or larger even, depending on the market conditions that come. And being able to identify that is where the value is in investing. Knowing where the risk is and knowing what the upside potential is, and then the difference between all of that, and then making decisions on how to allocate to your portfolio in those positions. That's where all the value's at. I'm looking at 2024, so I'm going to pull up some other data here. Um, here's a potential area that I think is um, out of sentiment. People are very fed up with a lot of commodity companies, and especially in gold and silver. But this is an opportunity, guys. If we can break this downtrend line, it's a huge opportunity. One of the things that I think could potentially occur here is we've got the market conditions could be swinging around potentially for gold and silver. And I think the gold and silver mining companies, if we can break through this downtrend, I think are going to do some crazy, crazy things. I have been positioning in some of these companies lately and have been accumulating, I think, at very, very good times. And the charts look very good. The fractals look very good. Everything looks very good. And I'm trying to find what I think are some of the best risk reward companies. And yes, I am going out on the risk curve with some of them, with some of my money to try to push the returns. I'm going to try to do that. One of the differences that people I don't think understand is that they said, well, how, gold and silver, it's not going to go up, the mining companies. Last bull market occurred from 98, 99 from this ratio, and it exited 2011 with the ratio going lower. This is 2011 here. The ratio went from that circle downward to here. So the ratio for gold and silver mining companies from 98 to 2011 went lower during a bull market of gold and silver. What does that mean? It means that the gold and silver mining companies underperform gold itself. And what we've got now is we basically are trying to make a stand. We've got a big downtrend. And we are making what I think could be a stand here where we get a potential reversal. Now, let me redraw this here, guys. And what we're trying to do is we're trying to break this downtrend line. If we can break through this downtrend line, and we haven't done so yet, that means that gold and silver are going to start to outperform gold. And that's a shift in the markets that I think a lot of people maybe don't expect. And that's where you have to be standing alone, thinking by yourself, and not following the herd. Now, if that were to go up and we were to go back to 90s valuations, which is in the upper left here, we go back to those valuations, and that happens during a gold bull market, gold and silver mining companies are going to go ballistic. That's my opinion. If we get the right market conditions, this breaks out. The outperformance, if we were to look here, of where we're at today, that's that green line right there. If we were to go back to, up here, that's oops, I took the wrong thing here. 1 second. I got to take the price range. That means we have an outperformance of about 5x. So if gold were to go up, some people think that it could go to $8,000. Let's say it goes up 3x. Okay, we go $6,000. That means that you're going to have an outperformance of 5. So it'd be 5 times 3 is 15x, is what XAU would do if it were to get revalued against gold in that manner. 15x. That is the index, XAU, the total thing. There's going to be companies in some of these areas that could go far past that. It could be 30x, 40x, 100x, maybe. I don't necessarily might not know some of the 100x companies, but I think some of the 10, 20, 30x ones, yeah, I think there's a high probability of that potentially occurring if we can get a breakout, et cetera, et cetera. So that is something that I'm watching. That's probably one of the cheapest sectors in the market today. There's natural gas too, which is incredibly cheap, but there's some really good opportunities out there. And some of the opportunities that we're entering, they're in sectors like iron ore, in sectors like copper, or a combination of all those things. They pay, 8, 9% dividend yields. There's other companies that pay between, 15, 16, 17, 18, 19, 20% dividend yields that we have accumulated, and we're getting paid that amount of yield to hold. And here's the crazy thing. There's a lot of upside in that dividend yield where it can go up because their dividends are paid a percent of cash flow. And if they have day rates or their commodity price is cheap, that means that you've got upside potential in your dividend and upside potential in the stock price. And with where I think they are potentially going to go, we're going to continue to get higher and higher dividend payouts. As the stock price goes up, your dividend yield may go down or stay the same, but on your original purchase price, you can easily make a lot more money. Now, I'm just going to give an example here. I don't think people think about this necessarily. Here's one example. It was an example that I used when I purchased Vale in one of my accounts back in 2016. So here's an example just to give you guys an example of what I am talking about. 2016, we had a falling wedge. This is something that I teach. The falling wedge is this wedge here that I'm talking about. That's the wedge. And I purchased it right at the tip of this wedge. As you guys know from the website, I do a lot of wedge purchases. um, so let's just say, as an example, you purchased in the breakout here about $4. So let's say you bought 2,000 shares, $8,000 worth of Vale stock. So you've got $8,000 of Vale stock for 2 grand. So I'm going to bring up the calculator. That value today with $2,000 or 2,000 shares, I mean, times 15.86, the value of that stock would be $31,720. That is what your 8,000 has turned into. But what you're not thinking about necessarily is what are your dividend yields per year? Now, your dividend yield, and I'm going to go straight to the information to give you an exact dividend. And if we were to look at the dividend yield in 2023, these are the payouts that you received in dividends. So the dividend yield, 0.132 plus 313. That's all the dividends that were paid in 2023. It's 1.185 times 2,000 shares, and you have $2,370 of dividend yield that you would have collected if you had purchased at that time and held it the entire time. On your original investment amount of $8,000, your dividend yield is 29.6% on your original purchase price of Vale in 2016. Now, this dividend yield will fluctuate based off of the price of iron ore and other stuff. So part of my return is coming from this dividend yield that when I purchased it, and I purchased it lower than that price that I gave you. I purchased it lower than $4. On some, that's just one position. I'm just using this as an example. So I'm earning 29.6% dividend yield well, it's higher than that, on my original purchase price. Now, they weren't paying that at the beginning when I first purchased that. That is what's happening today, and obviously you can see that we're breaking out to the upside here. And this is one of our picks on the website, was buying it at this corner here and buying it on the breakout. Just to give an example of a company that I'm using. This is a big iron ore, copper, nickel company. It's located in Brazil. You can also see that EWZ is breaking to the upside of the ETF. These are some of the things that I look at and some of the things that I purchase over time. Now, there's a lot more companies out there that pay ridiculous yields, that are at very good entry points, better than even this one, or as good as this one, and are cheap. Very, 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 very cheap. So I know somebody wanted me to describe my returns, and I don't really like to share some of those returns, but um, my returns are a little over 40% on an annualized basis for the past 5 years. And that's roughly what I returned this year, is in the low 40s. So it's all kind of around that area. Now, obviously, there could be downside risk with a lot of these investments. If we get a pullback or a recession, it's going to give us one heck of a buying opportunity. And those returns are going to fluctuate based off of the market fluctuations. Yeah, it's definitely possible that we could get a slowdown in 2023. It's definitely possible that we don't. And I don't invest based off of market predictions. I invest off of the entry points that are there. Right now, there's entry points, and right now things look good, and that's all I can go off of. I don't make up stories. I don't make up narratives to go with or against whatever the charts are telling me, and what the ratios and value, where the value is in the market. So I just do what the market is telling me and projecting, whatever it's telling me through the charts. It's an unbiased approach, and I don't need the news or people creating narratives to cloud my judgment on it. I follow and track basically the money flows coming in and out of stocks. And that's what guides my decisions in the market. I could probably shut off the majority. Well, I don't even watch really news, and I listen to YouTube clips for entertainment sometimes. But for the most part, you could shut that all off, and I do the same thing that I'm doing today. It would be the same approach, and I would be doing the same exact things. I don't listen to other people necessarily. I think and do what I think is best. It is solely my opinions and solely my judgment that I'm using. I can listen to other people, but it's not going to necessarily change my viewpoint unless they bring up something like a new skill that I could maybe develop and learn from. But most people don't share those skills with people over YouTube. They just don't. They just give opinions, which then lowers the value of whatever they're giving, because you need to learn this stuff. And I want to learn more and refine if I can. and most people don't share their exact methods of what exactly they are doing. So they just give opinions, and opinions are they're just like the rear end, everyone's got one, and sometimes they stink. So that's kind of what's going on in 2024. I think there's potential around precious metals and potentially gold mining and royalty companies and stuff like that if the market conditions do start to change. And then I think there's other opportunities in other sectors as well. You've got copper, iron ore, and a bunch of other stuff. And I'm going through and sifting through all of the companies that potentially could do well. And you can use this as a pick, Vale, for 2024. I think this is a solid risk reward play. They pay a dividend yield right now of 7.4%. It is an iron ore, nickel, copper play. I think copper and iron ore and steel and all these different areas of where a lot of these commodities are located, I think they look pretty good. And this would be a company that I think looks pretty solid. This is a lower risk, I think, lower risk play. It's a big company. It's a market cap of 68 billion, not a small little market cap. And I think the upside potential is actually very good. I think it's a very good risk reward play. So that would be a 2024 pick of mine. Would be Vale if I were to choose a single company based off of risk reward, based off of a good dividend yield, based off of where iron ore is located and copper is located and all these other ones, based off the valuation, based off the technical chart pattern we've got behind me, et cetera, et cetera. I think that's a good solid 2024 pick, in my opinion. And we've got stuff that is more risky than this that could potentially give you more upside, but the probability of success may not be as high as this one. So now that's what you have to balance. What's the probability of success in the market? So that's my return for 2023. That's been my return for my 5-year annualized average on all my accounts for that account. I've got 6 accounts. The other ones, they don't show it in that type of manner, but they're all very similar. They're all probably around that same amount because I hold all the same companies for the most part. Um, and then I've got other holdings as well that are outside of the system, physical metals, stuff like that, which also is not in any of those accounts or in any of those type of measurements. So 2024, I'm positive on it. I think we'll have a good year, hopefully. Hopefully we don't get some recession, and these things can go up even in a recession. Commodities can go up. I'm not stating that they will for surely go up. If it's a large pullback or recession, then they're definitely going to go down. But if it's just a small slowdown, we could grind, we can go up, we can grind sideways and then go up, stair step up real slowly. It could be a muted year where we just don't go up as much. I'm not stating that we're going to get some big blowout crash or anything. The housing market can still go up during a slowdown in stocks if that does occur. And I think people think that we're just going to get some big, great financial crisis. And I don't think that a great financial crisis is necessarily going to come if we do get a slowdown. If it does come, you're going to probably see money printing. They're probably going to try to stop it, especially during an election year. There's all these politics behind it. They could potentially ship people checks. If that were to occur, these things are going to do very, very well. They are going to do very well because they're basically pumping money back into the system. Gold's going to sniff that out, and gold's going to go up quite a bit. And I think the gold and silver mining companies could do some crazy stuff. And depending on how big they use stimulus, if they were to do that, that would determine how big the moves could potentially be in precious metals and the underlying gold and silver mining companies and some of these other precious metals companies. So that's what I've got. If you do want to join the community, you can join. We still have a discount going on. Holidays is something that you could use for a discount. And this is a 2024 pick if you want to use it, VALE. I think it's a solid lower risk pick. it is a base metals mining company. It could be subject to slowdowns in the market. There is risk associated with it, just like any other company. It is located in Brazil, and the slowdown would impact potentially the base metals if we do get a slowdown. So that's what I've got for today, guys. Give me a thumb up for the content. Subscribe to the channel. Subscribe to the website if you'd like. We do have question and answer sessions. We've got midweek updates that I provide, and I go into the individual companies just like I did here. Like Vale, I chart them out and I make comments about this. This is your consolidation period. This is your breakout of that consolidation period. This is kind of like your returns slow move afterwards, and we're starting to break to the upside there for this particular stock. And then I go in and I talk about these potential setups, and some of the setups are located here, right in the corner, that have very good potential upside with very minimal downside risk if there is any. And that's what I'm trying to do is maximize the symmetry of the move. And that's one example. Give you an example of what it is. So now you know what my returns are for the five-year annualized return. You can ask anybody who's a member already if you want me to bring some, try to get some people some feedback. They can give feedback. This is one of our picks that I continue to go over. We've got other picks that are smaller cap picks in energy service that have done multiple hundreds of percents. And we probably have 4 or 5 companies that are over 100% or so. We have a lot that are up 40, 50% in a few months only of holdings. They've kind of broken out of some of these patterns, and a lot of the times what you'll see is you'll get a falling wedge. They'll break out and surge higher just like this. This went from $2 to $15, multiple hundreds of percents in this move right here. And that's what I'm going after. That is what I'm using. It's not just this one chart. It's a combination of things that I'm stacking together. It's not just one thing to get our entry points to reduce the risk. But that's what I've got, guys. So I'll end it there. We'll catch you guys later. This is Finding Value.